Hi, welcome back. In past videos, I have shared the stocks in my portfolio, but I haven't got the chance to walk through with you how I built my portfolio. So in today's video, I'm going to go through this step by step. So step number 1 is pay yourself first. Every month when you receive your salary, make sure that you set aside a certain amount of money to be invested. Step 2, which is one of the most important steps, is decide a target allocation. So a target allocation is basically a list of stock or ETF and with their associated percentage allocation. So step number 3 is every month check the actual allocations and compare it against the target allocation. And step number 4 is after you do the comparison, you buy the one that is underweighted. So as an example, if you have a target allocations of 10% to be invested into Apple and your actual allocations is only 5%, then you will buy into Apple shares to make up for the difference. So this way you don't have to bother to sell stocks that is over allocated, because over time when you consistently buy into stock that is underweighted, then you will move towards the target allocations. Basically that's it. These are the 4 steps I use to build my own portfolio. Let's go through some of the Q&A. First question is, how do you pick stocks? So for me personally, I prefer companies with solid fundamental. So by solid fundamental, I mean companies with good revenue growth, increasing net income, and decent return on capital. So usually I will use the website macro trends because they provided the trend of the revenue, the net income, and so on. So second criteria that I use is companies that benefit from global trends. So one good example of global trends is cloud computing. Nowadays, more and more processes and workflows are migrating from on-premises servers to cloud computing. This helps companies a lot because using cloud servers, it is easier for them to scale. So although cloud computing has been around for quite some time, but I think that there's still long runway for it to go. The reason is because when you look at how companies operate, there are still many companies that are relying on on-premises servers right now. So in the next 10 to 20 years, I expect more and more companies will move towards the cloud. Next trend that is related to the cloud computing is artificial intelligence. So AI is not just a buzzword anymore. As you can see, it is used in more and more areas. For example, when you visit Amazon website, how they do the recommendations is based on AI. And when you are using YouTube and YouTube keep on recommending videos that you may like, those are also based on AI as well. And right now, I think that there's still many companies that haven't adopting AI in their business. And this will change in the next few years. Another trend that I would like to talk about is ARM architecture. So regardless of whether you are using iPhone or using Android, they are based on ARM architecture. But slowly we see that ARM architecture replacing x87 architecture. This is because ARM architecture has a couple of benefits that is very important. One of them is that it is much more energy efficient. So Apple has adopted ARM architecture in their MacBook, and slowly even Windows laptop will move towards ARM as well. So I think companies that benefit from these global trends will do well because it will actually push up their revenues and their net income in the future. And third criteria that I'm looking at is great management and great culture. This is more towards qualitative assessment as compared to the numerical or quantitative assessment for fundamentals. So what can we do to assess the quality of the management? There are many ways to do it, but for me personally, I would like to research on the CEO or the founders themselves. For example, I will search their names in the YouTube and just watch their videos and try to understand what is their philosophy and how they manage or how they see the business. The annual shareholder letter is also a very good resource. As good CEO will use the shareholder letter to educate their investors and communicate important messages. If you have not read shareholder letter before, I would strongly recommend that you read letters from Jeff Bezos because I think that his letter is actually a very good resource. It's like an MBA education. And the fourth criteria that I'm looking at is strong moats. So strong moats is basically how defensive is the business. For example, companies with very strong brand names will have strong moats. Say for example, users that are using iPhone will tend to buy another iPhone when they are changing phones instead of looking for other brands. And Tesla is also a very good example. Try to convince a Tesla users to buy BMW or Toyota. It's unlikely for them to change because Tesla have a very strong brand name in the EV space. So basically, these are the 4 main criteria, and these are based on both quantitative and qualitative assessment. So next question. I don't know how to pick stocks. What should I do? Okay, this is an easy one because if you don't have idea on how to pick stocks, or you don't have any preference on which stocks to own, then you can just buy ETF. ETF is just a basket of companies. So by buying just one ETF, you get exposed to hundreds or even thousands of companies. And because there are so many companies in a broad market ETF, it is very diversified and the allocation to each stock is very small. You don't have to worry about a particular company at any moment of time. So let's take a look at one of the most popular ETF, which is the SPY. So this ETF tracks S&P 500 index. The historical return in the past 10 years is 14% and the historical return since inception is about 10%. So you might think that 10% is very low returns and just not attractive enough. But please remember, because of the power of the compounding, if you can enjoy 10% return and based on the rule of 72, every 7 years your portfolio will double. And if you know that your portfolio will double every 7 years, what will you do? In order to earn 100,000, what you need to do is just make sure that you have 100,000 invested, and after 7 years, they will double, become 200,000. And after another 7 years, it will double again to become 400,000. So over time, you will definitely build a large portfolio that can fund your retirement. In terms of how to research ETF, I would recommend this website, etf.com. So you just go to the ETF tools and data and select the ETF screener and database. And there are different filters. For example, you can choose different types of asset class, and you can choose different geographical location, and even you can choose the issuers. So for ETF, please pay attention to the expenses. Some of the smaller ETF can be quite expensive. And just now when we talk about the global trends, I mentioned about the cloud computing. There are so many companies that operate in the cloud computing space. And if you don't know how to pick the right companies, what you can do is you can choose an ETF, for example, the WCLD, which is offered by WisdomTree, and you can study the details. If you go to their website, they actually shows a lot of details. So I think this ETF is an interesting one. I'm still studying it. Probably I will add this ETF into my portfolio in the future. Let's move on to next question. How many stocks should I own? Should we use a sniper theory or diversification? I will use this chart to explain how many stocks that you should own. So on the x-axis, this is the number of stocks that you should own, and on the y-axis, this is your understanding on the particular companies. For example, if you are the person who like to do deep analysis into the companies and know the companies inside out, it is fine to own small number of companies. However, if you are the type of person that do not like to study companies in details, then spread out your investment over a number of companies will be a good idea. And if you do not want to spend time at all at researching companies, follow the company's news and so on, just invest 100% into an ETF is also a good idea. So I know that Chicken Genius recommended an approach to investing which is based on sniper theory. Basically, he invested 80% of his portfolio into just one company, Tesla. I think it is fine to concentrate 80% or 90% of your portfolio into one company, but just make sure that you have a very true rough understanding on that company. For example, you can basically ask Chicken Genius any question about Tesla, he will able to answer you because he have done all the research. But if you have not done the research to that extent, then please don't do according to what he has done. Why we shouldn't concentrate in a company if we have not done enough research? So the thing is, yes, Tesla has performed very well in the past 1 year. However, the performance against the broad market is not smooth. I'm sure that looking forward, there will be period where the companies that you want to concentrate on will underperform the market. And if you have not done enough research, then when the stocks that you concentrate on underperform for quite some time, it is quite likely that you will abandon your conviction or your strategy. So when there's dip in the market for the stocks that you own, you will just panic selling. So that will not help in your portfolio building. And if you panic sell, that will cause a permanent capital loss. So I have prepared a couple of quiz questions just to test your understanding on the company. I'm using Tesla as an example, but you can apply this type of questions to any companies. So quiz question number 1. How many cars Tesla is expecting to deliver in 2021? So the next question is about full self-driving. Which level of full self-driving is Tesla at currently? And do you know that in total, how many levels of autonomous driving is there? And when is the next announcement by Tesla on their full self-driving? Okay, third question is, how much do you know about Tesla energy generation and their storage business? For example, like their revenue growth, and their competition in this space. And fourth question, tell me a name of one of Tesla executive other than Elon Musk. So if you can't answer this quiz questions comfortably, it just shows that you still do not have a good understanding on the company. That doesn't mean that you can't invest in the company, it's just that it is not recommended to over-concentrate into one company without deep understanding. Alright, let's move on to the next question. Shouldn't we buy and sell depending on the stock prices? So I do not advocate buy and sell based on the recent price movement. I would recommend that you spend more time into researching the companies and come up with a target allocations that you can use over time. I know that whenever the share price of a particular company drop, we have a strong tendency to buy into them. We can come up with all sorts of reasons. For example, we might say that it is cheaper now, I should buy more. And also, there's this strong tendency to lower down your average purchase price. So if we see this from a portfolio construction perspective, do you want to risk the entire portfolio for just one company? What if we are wrong and the company continue to experience falling knife? And if we overreact and concentrate all of our monies into just one company, you are basically neglecting the other companies that you already set in your target allocation. Take Alibaba as an example. So the price has dropped to about $222 last week, and this price level looks attractive compared to their prices at about 300 plus. But the question is this price level is attractive enough for you to change your target allocation? If you think that 222 is enough to change your target allocations, then my question is why you have not set a higher target allocation for Alibaba when their prices is below 222. So if we look at it from a short-term perspective, the price drop that Alibaba experienced last week does look dramatic. However, if we just look at the historical prices long enough, the price 222 is just the level of their share price at first half of this year. So the last question is, how often do we need to review our target allocation? At the beginning, when we just come up with a target allocations and we are still not sure, it is fine to fine-tune or change the target allocations more frequently. And over time, when you are getting more and more comfortable with your target allocations, it will tend to stabilize. So I hope that this portfolio construction video will help you. I think this method has the benefit of provide some calm to our investing, and the target allocation that we set for ourselves will guide our investment in the future. That's all about today's video. Hope you like it. See you in the next one.